If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. While global markets face unprecedented volatility, one Southeast Asian economy stands remarkably resilient. Malaysia's economy in Q2 2025 manifested a commendable degree of stability, with solid GDP growth, low unemployment, modest inflation, a cautiously easing interest rate, and manageable debt levels. These indicators reflect resilience in the face of global volatility. The GDP annual growth rate held firm in Q2, with advance estimates placing expansion at 4.5% year-on-year, matching the Q1 pace. This performance pointed to sustained momentum from late 2024, when annual GDP growth was approximately 5.1%. The growth in Q2 was notably driven by strong domestic consumption and construction activity, as well as steady manufacturing even as external demand cooled. The unemployment rate remained low, around 3.0% in Q2 2025, the lowest level in a decade. Unemployed persons numbered approximately 518,700. This steady labor market outcome, with stable jobless figures and improving labor force participation, underpinned domestic demand and supported growth in services and construction sectors. The interest rate environment saw the first move in 5 years. After a prolonged static period at 3.0%, Banknegaramalaysia implemented a 25 basis point cut to 2.75% in July 2025. This mild easing signaled support for slowing growth while maintaining macroprudential vigilance. Rate cuts remain cautious, reflecting the central bank's balanced approach. Inflation moderated further. Headline CPI declined to approximately 1.2% in May, and dropped to 1.1% by June 2025, reaching the lowest levels seen in over 4 years. Core inflation, which excludes volatile fresh food and administered prices, stood around 1.8%, its highest mark since late 2023 but still within moderate bounds. These trends suggest stable consumer prices with limited pressure on purchasing power. Malaysia's debt-to-GDP ratio remained moderate. In 2024, public debt stood at roughly 70.4% of GDP, up modestly year-on-year. Projections into 2025 estimate the ratio to remain near 66%, reflecting government fiscal discipline. Elevated debt levels impose some constraints on discretionary spending but remain manageable. Summarizing key macro indicators. GDP growth, 5.1% in 2024, steady 4.5% in Q2 2025. Unemployment, approximately 3.0% in Q2 2025, long-term low. Interest rate, cut from 3.0% to 2.75% in July 2025. Inflation, headline approximately 1.1%, core approximately 1.8%. Debt to GDP, approximately 70% in 2024, expected approximately 65% in 2025. The structural strengths include domestic demand resilience, evident in robust household spending, and investment in housing and infrastructure. Consumer confidence remains steady, bolstered by employment security and wage trends, while credit growth supported private sector activity. Construction and real estate sectors contributed significantly to Q2 expansion, offering employment and anchoring domestic demand. Public and private infrastructure spending, including green and digital initiatives, provided additional support to growth pipelines. Manufacturing, especially of electrical and electronics goods, remained an export pillar, though export growth showed signs of moderation amid global uncertainty. Nevertheless, manufacturing output held steady, contributing to overall economic balance. Services sectors, including retail, tourism, and professional services, reflected healthy performance. Tourism receipts improved with continued easing of global travel restrictions, supporting hospitality and transport sectors. Inflation moderation underpinned real income stability. Lower food and fuel prices contributed to declining headline inflation, while wage pressures remained moderate, sustaining consumption strength. Interest rate cuts signaled measured policy support for growth. While still restrictive, the 2.75% benchmark rate marked a shift toward accommodative bias, expected to aid SMEs and housing demand without compromising price stability. Fiscal prudence retained its role. Moderate debt and a stable fiscal profile provide Malaysia with the fiscal space needed to coordinate counter-cyclical support. If global conditions deteriorate, external stability remained intact, while export momentum softened. Remittances and export of commodities provided ongoing support. Strong reserves and stable external accounts underpinned confidence in the currency and financial system. Challenges to continued stability include exposure to global trade shocks, particularly U.S. tariffs, and structural dependence on cyclical sectors, like exports and construction. Ensuring longer-term resilience may require diversification and productivity enhancements. Policy recommendations to sustain stability: extend monetary easing gradually. Further cuts may be warranted if inflation remains low, with careful calibration. Enhance fiscal targeting toward productivity projects such as digital infrastructure and green innovation. Boost private investment, especially in diversified manufacturing and service sectors, through incentives and regulatory ease. Strengthen formal sector employment by addressing underemployment and aligning skills development with evolving industry needs. Manage debt prudently, channeling borrowing toward capacity-enhancing investments. Expand export diversification into high-value sectors, reducing reliance on trade corridors vulnerable to tariffs. Monitor inflationary risks, particularly from administered prices, and respond preemptively to contain volatility. If implemented effectively, these measures could enable Malaysia to sustain GDP growth in the range of 4 to 5%, maintain unemployment near 3%, support inflation moderation near 1 to 2%, and stabilize debt to GDP around 65% through 2026. In conclusion, Q2 2025 showcased a stable Malaysia economy, marked by consistent growth, robust employment, benign inflation, the beginning of monetary easing, and reasonable fiscal health. The resilience is anchored in strong domestic dynamics, diversified economic activity, and measured policy responses. Continued attention to structural reform, balanced stimulus, and external diversification will be vital to sustaining stability amid evolving global trends. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.